Expanding a startup across borders marks a significant milestone. It signals growth, opportunity, and the potential to reach new markets. However, with this growth comes a complex array of tax challenges that could impact the company's financial stability and operational success. Understanding these challenges is critical for startups to navigate the complexities of international taxation and remain compliant while optimizing their tax position. One of the first issues startups face is the risk of creating a permanent establishment, PE, in the target jurisdiction. A PE is a taxable presence that arises when a company conducts sufficient business activity in a foreign country, triggering local tax obligations. Key triggers for PE: activities such as maintaining a local office, employing staff in the jurisdiction, or appointing agents who habitually conclude contracts can lead to PE. Digital businesses often struggle to determine when a PE is created, especially with differing rules on significant economic presence. Mitigation strategies. Startups should carefully structure their operations abroad, considering outsourcing or appointing independent agents to avoid unintended PEs. Consulting with tax advisors to review tax treaties and domestic rules is essential. Transfer pricing refers to the pricing of transactions between related entities in different countries. Tax authorities scrutinize these transactions to ensure that profits are not artificially shifted to low-tax jurisdictions. Challenges for startups. Startups often lack the internal resources or data to create robust transfer pricing documentation. Mispriced intercompany transactions can lead to double taxation or penalties. Best practices. Develop a clear transfer pricing policy aligned with the arm's length principle. Startups should focus on proper documentation and consider benchmarking studies to support their intercompany pricing. Indirect taxes such as VAT, GST, and sales tax are another significant hurdle for startups expanding internationally. These taxes vary widely by jurisdiction and apply to a range of transactions, including sales of goods, services, and digital products. Complexities. Startups selling digital goods may face multiple VAT registration obligations in different countries, especially under rules like the EU VAT Directive for e-commerce. Recommendations. Use automated tools to calculate and file indirect taxes accurately. Startups should determine if they qualify for any simplification measures, such as the One-Stop Shop (OSS) in the EU. Cross-border expansions often require employees to work in new jurisdictions. This creates tax obligations for both the company and the employees. Corporate tax risks. Employee activities in foreign countries can create a PE or trigger withholding tax obligations on payroll. Employee tax risks. Employees may become tax residents in the host country, leading to double taxation or compliance burdens. Solutions. Implement clear mobility policies and coordinate with tax advisors to manage withholding taxes and assess potential double taxation risks. Operating in multiple jurisdictions often results in the same income being taxed twice, particularly when income is taxed in both the home and host country. Double taxation mechanisms. This issue arises due to mismatches in tax systems, differences in rules for profit allocation, or disputes over tax residency. Relief options. Startups can leverage double tax treaties to claim relief through exemptions or credits. It's vital to maintain proper documentation to substantiate claims. Many countries offer tax incentives for research and development, R&D, investment, or employment. However, navigating these incentives can be a double-edged sword. Opportunity versus risk. While incentives can reduce tax liability, improper claims or non-compliance with eligibility criteria can lead to audits, penalties, or reputational damage. Action plan. Engage local advisors to evaluate eligibility for incentives and ensure compliance with reporting requirements. Startups should maintain meticulous records to justify claims during audits. Cross-border activities introduce foreign exchange, FX risks, and multi-currency complexities. Fluctuations in FX rates can create tax liabilities or mismatches in reporting. Common issues. Unrealized FX gains or losses can be taxed in certain jurisdictions, leading to cash flow issues for startups. Practical steps. Work with accountants to adopt FX hedging strategies and ensure that currency transactions are properly reported for tax purposes. Choosing the right corporate structure for expansion is crucial for managing tax liabilities. Whether to set up a subsidiary, branch, or joint venture can have far-reaching implications. Decision factors. Startups must consider local tax rates, withholding taxes on profit repatriation, and operational flexibility when choosing a structure. Strategic approach. Analyze the pros and cons of each option, taking into account local corporate tax rules and double tax treaties. Expanding across borders is an exciting yet challenging endeavor for startups. Understanding the potential tax pitfalls and implementing proactive strategies can prevent costly mistakes and enable sustainable growth. Startups should seek expert advice, adopt robust tax compliance tools, and remain agile in adapting to regulatory changes. By addressing these tax challenges head-on, startups can focus on achieving their growth objectives while maintaining a solid foundation for international operations.